Hi, everyone. This week, OPEC Plus surprised the world by cutting production. For a deep dive on what this means for the economy and geopolitics, I'm joined by Harris Kupperman, founder of Praetorian Capital Management. Hi, Cuppy. How are you?
I'm doing well, thanks. How are you?
I'm doing okay. So we know that you're paying attention to the oil patch. So we wanted to catch up with you, and we had a quick email exchange because you're paying close attention to this. And it really did. OPEC Plus's decision to cut the supply really did seem to catch the market off guard. Clearly, everyone's been worried about banking and a banking crisis. But what's your take on this? What do you think was behind that?
Well, I think OPEC Plus looked at the SPR draining and they kind of realized that this was their moment to exert pressure. I mean, without an SPR to play defense, they can move the price however they want, and they're in the business of maximizing price, so they're going to move the price higher. And we're at a moment in time with not a lot of incremental supply that can come online. And yeah, they're going to move the price higher, especially because demand is really, really strong. I think also OPEC is really looking at what the Federal Reserve is doing with raising interest rates. And when the Federal Reserve raises interest rates, one of the key components of inflation is energy. And the Federal Reserve is basically saying we want the energy price to go down because we want to destroy demand. And OPEC is saying, hey, wait a second, like we need demand. And so if the Federal Reserve is going around the world destroying demand, and when I say destroying demand, it's not really in America because American oil consumption doesn't really change that much. With the economic cycle, it's really emerging markets where they don't have the same amount of purchasing power, and often their currencies depreciate, which makes it harder to buy oil. But if the Federal Reserve is going around the world and basically trying to create economic crises in all these emerging markets, well, then that's going to destroy energy demand. And OPEC's just saying, hey, if you try to play this game and destroy energy demand, we're just going to destroy supply. We're going to end up in the same spot. And it's a race to the bottom. And no one wants a race to the bottom. In the end, and I don't think J-Powell's realized this yet, OPEC's the one driving the bus here, and they're and J-Powell's kind of in the back seat, and he thinks he's driving it, but he's just kind of a passenger. In the end, the price of oil drives inflation, and OPEC drives oil.
Yeah, and we saw that was such a problem before. So a couple things here. OPEC traditionally likes to keep it somewhere in the middle, though, because if there is too much upward pressure on oil prices, as you just mentioned, that will kill demand. So are they just trying to keep it in a range here? Or because we have people talking about $100 barrel of oil again. I mean, right now we saw that pop after the news, and it's kind of sitting right around $79, $80 for light sweet crude. Do you think that they just want to stabilize it, or are they trying to put upward pressure on prices here?
Well, I mean, I think they want it in a range. Obviously, a too high price destroys demand, and no one wants that. But I think, the world can deal with a price that's triple digits. I mean, if you go back to 2012 to 2014, oil was pretty consistently around $100. Adjust that for inflation, you'd be around 150 today. And, the world functioned just fine. I just don't see why we can't have a price in the 100 to 150 range, as opposed to, this range we've kind of grown used to, which is kind of this 50 to 75 range over the last 6 years. I think OPEC plans to guide it there. I don't think OPEC wants it to be spiky, but OPEC wants it to, over time, go back into that other range. And, I think they're going to get it there.
So, there's been a lot made of the fact that this is uncomfortable for U.S., for Europe, who are trying to fight inflation. They're trying to do that. They're trying to manage the economy through. Is this a sign of a larger political rift?
Well, I think so. I mean, I think the Middle East, which has always been a place where we just arbitrarily bombed countries, it's kind of unfortunate, actually. I think a lot of the Middle East countries have kind of gotten together. I mean, you see Iran and Saudi are, I don't want to say friends, but they're talking again. I think they've realized that, they don't sell much oil to the U.S. anymore. They're selling their oil to India and Africa and China. And I think they're going to, move out of our orbit into their orbit. And it's kind of unfortunate for America. But I think that's the direction things are going. And that rift means that they're not as focused on what happens here and in Europe. They're more focused on their new customers. Yeah, I think that they're just going to do what's best for the Middle East.
Yeah, those new customers. So, what are the implications of that, do you think?
I don't know. It's probably not good for the U.S.
Yeah. What do you think it means for oil prices, though? Because the new customers don't want high oil prices either, right? Anybody who's importing oil wants to keep oil, low as they can.
Well, I think what's going to happen is these new customers are going to pay in their traditional currencies, the national currencies. They're not going to pay in dollars anymore. And so the net result is you're going to see some of these currencies appreciate because they can purchase oil in their own currency. They don't need dollars. And that's always been, what made the U.S. strong is that the world needed our dollars to buy energy and all this other stuff. But if they're willing to take rupees, and they're willing to take rupees at a discounted price, Russia is right now, well, then the rupee is probably going to appreciate against the dollar, and India is going to have more purchasing power. And then it's not going to feel so expensive to pay $100 or $125 oil because you can do it in rupees so you can print. It's going to disintermediate the dollar. And like I said, it's probably not good for America, but it's probably very good for, oil prices priced in dollars.
So do you think that the market is, we saw that big decline in oil. Everyone's anticipating that we're going into a recession. That's going to hurt demand. Do you think that the market is mispricing the oil narrative here?
Yeah, I mean, there is no recession coming. I just don't see it. We talk to companies all day long. Things kind of got slow in Q4. I'd say the worst of it was November or December. And every month incrementally, it's accelerating. You have to understand there's two economies in America. You have the economy that's driven by interest rates. That's commercial real estate, it's private equity, hedge funds, VC. Like that economy's suffering. It's slowing down. Then you have the whole rest of the economy, which is capital goods, it's services, it's everything else that we consume. A lot of it happens in flyover country as opposed to coastal cities, and that's booming out of control. And I think people focus on the overall GDP numbers, and they're missing the fact that large parts of the country are really doing well, and those are the parts of the country that drive a lot. And no, I think the demand for oil is going to stay very high. The number just came out today. There's huge draws. I think we're going to see huge draws of oil in the U.S. every week going forward now until it hits zero, or they start drilling for more oil. And the only time that they start drilling for more oil is at a much higher price. And then there's a lag. No, I think the demand is very strong, and I think the world's gotten way too focused on what the U.S. is doing because we used to be such a big piece of the oil puzzle, and then Europe was the second biggest piece. But the incremental demand, it's not here. I mean, Europe and the U.S. have almost flatlined for a decade now. It's really India where, look, they sold 50% more motorbikes this year than last year. I mean, those motorbikes are, future demand for oil. Look at what's happening in China. Look at Africa. Look at, Southeast Asia. It's all, growing very, very rapidly in terms of oil demand. And people forget that there's 6 billion people on this earth that want the same standard of living that I have. And I'm sitting here with air conditioning. I got all my lights on, I got a microwave, and I just drove to work. Like most of these people don't have any of these things yet, but I believe in human progress. And I think in 20 years, they're going to have most of the same toys that I have. And as a result, they're going to need a lot more energy. And obviously, petroleum products are, a dramatic, substantial piece of that future energy consumption.
Can Middle East producers meet that kind of demand?
No, they can't. If you look at what's happening in the Middle East, a couple of the countries have some spare capacity. Obviously, these recent cuts add to that spare capacity. But we're talking about 1 year worth of global growth. I mean, they're full. Look at Saudi, which has always been, the big player in OPEC. I mean, the fact that they're aggressively going offshore right now, the fact that offshore is far more technologically complex, it's far more expensive, it's longer cycle. The fact that they're aggressively bringing rigs into the Arabian Gulf, I think it just shows that their onshore production is in decline now, and it's rapidly in decline. And they have better data than I have, obviously, but they wouldn't be going after this much more expensive oil if they had onshore stuff that they could ramp up. And I mean, I think the Middle East, all of OPEC probably has 2 million barrels of spare capacity, maybe 3 at most, but global demand is probably going to grow 3 a year. So, maybe you can postpone the problem a year, but you can't postpone it indefinitely. And, oil has to come from somewhere. And there's been a 7-year period with really minimal exploration expenditure. And unlike U.S. shale, where you kind of flip a switch and 6 months later you have oil, the vast majority of the world's oil comes from a long cycle that takes 5 or 10 years of planning and spending and they're not going to be able to turn it on fast enough. I think you're going to have an energy crisis.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
So do you, first of all, let's dig into that energy crisis a little bit. What happens to the price? Sort of give me your price target. If you think there's an energy crisis and there's not enough capacity to meet the demand for an economy that's presumably, in your view, stronger than people expect it is outside of the interest rate sensitive area, what are we talking about for a barrel of oil then? I mean, is $100 seem conservative against that? Or do we have a sort of, is this a longer term thesis? So in the next year or so, we'll stay range bound?
I mean, it's really hard to predict these things. I do believe that, the price of oil has to go to a level that incentivizes new production, because the demand doesn't ever get destroyed by the price of oil. Oil has to go much higher. It's not 100. It's 200-300. And so, no, I think you're going to see a new range for oil in the 100 to 200 range. And I think there's going to be some spikes because, as we've learned, oil is very geopolitical, and there's moments in time where oil comes offline and people get scared, and the price goes out of control. And oil has massive amounts of derivatives tied to it, and a lot of those derivatives are counterpartied with banks that are in trouble. I think you're going to see at least one or two super spikes along the way, and super spike can take you to a crazy number over a short period of time, just because you have some sort of derivative blow up or squeeze, whatever you want to call it. But no, I think you're going to see a much higher level to the price of oil. And just going back a second, the price of oil declined from last summer really until a few weeks ago. And I think people looked at it and said, this looks like recession. I think people missed the fact that, you had China offline, let's call it, 200 days at 3 million barrels a day. That's, 600 million barrels. You had Russia dump all of their refined and unrefined product, another 150 million barrels. You had a rather warm winter in the U.S. and in Europe. It's another 100 million barrels. So we're already posting 850 million barrels. And then you had the U.S. SPR dump another 250, let's call it. You're at 1.1 billion. You start going around the world and you say, wow, that's a lot of oil that just got dumped on the market in a 6 to 9 month period of time. And, the global inventories barely even rose. I mean, that oil got consumed, and it impacted the price, obviously. And at the very end, a couple of hedge funds had margin calls because they did crazy things with interest rates. But no, you had a lot of oil get dumped on the market, and most of it got consumed. And that oil, the weather you can't predict, but a lot of that oil isn't coming back. I mean, the SPR, they have a bit more to sell, but they don't have that much more. So I don't think it was that the economy was weak. I mean, the oil got consumed. It was just that you had these random things that happened simultaneously that pressured the price. And I think it gave people a very false sense of confidence. Meanwhile, on the production side, I think a lot of oil companies looked at what was happening with the price of oil. And when they were setting their 2023 budgets, they said, hey, let's pull back a bit. And so you just end up with another year with less spending. Meanwhile, you have massive inflation in oil field services. I mean, my mom, she complains about the price of broccoli and cucumbers and stuff. But if you're doing oil field services, you're getting 20-30% annual inflation. I mean, that's way worse than broccoli. And so your cost to get this oil out of the ground is accelerating, and it's accelerating rapidly. And these guys used to say they were breaking even at 50, but they couldn't have been because they all went bankrupt when oil was 70.
Yeah.
But if they were kind of breaking even at 70, they're probably not breaking even at 100 now. I mean, that's the thing about commodities, and it's just supply and demand. And you look at what the cost curves look like, and sure, there's some great places in the Permian that might still be at 50, but the vast majority of the world's oil needs a higher price.
So you just brought up a great point on that shale, that break even. That's what a lot of people talk about, right? They look at what point can you bring U.S. production back online? So for you, you think it's much higher than we are now.
Yeah, it's absolutely much higher. I mean, one, you're running out of tier 1 locations, so your EOR is going to be lower in the future. And then two, you have massive inflation of oil field services. No, I think the price is going to be much higher. And the world's not running out of oil. Don't get the wrong idea. The world's going to have a period of time, 2-3 year period, where there's a gap where you're not going to have the 3 million barrels a day of incremental supply that meets the 3 million barrels of incremental demand. And I think the second half of this year is going to be the first time where we really get to see what happens. We're getting pretty large draws. Look at today's draw. I mean, before OPEC did something, the global inventory was drawing 2 to 3 million barrels a day. Now we're drawing 3 to 5 million a day. And you can't draw at a couple percent of global production daily without there being a crisis. The crisis gets solved with much higher prices that destroy demand and incentivize people to do stuff. But you can incentivize people all day. It still takes them a couple of years to do stuff.
Yeah. So when we were facing the higher oil prices, there was a feeling that there was no way the U.S. could afford, especially when we're going to be facing an election year, to let oil run up that much. So they tapped the SPR. That's what they did. Now that the SPR is drained, do you see a situation where, in order to cap oil prices, they put an export ban on?
I mean, they'll try all sorts of stupid things. I mean, governments historically do really dumb things that make problems worse. That's the history of governments. I assume they'll try all sorts of things that'll fail. And all that it will do will be to destroy the supply response, because if the government's interfering in your ability to do your business, you're going to sit on the beach and enjoy your profits.
So you won't see the sort of production necessary in order to meet demand if there's some sort of export ban or some sort of price control.
Yeah, they're probably going to try excess profits taxes. They're probably going to try export bans and price caps and all sorts of other things. And the net result is that guys will take their dividends and go to the beach. They're not going to drill for oil. No, I think it's almost inevitable that the government will take a problem and turn it into a crisis.
And when we're looking at China, Africa, do you anticipate that demand remaining strong? A lot of people are concerned, look at China and say, okay, they reopened, but their economy is a mess behind the scenes. We don't really know what's going on. They have a huge property bubble problem. The level of growth they're going for anymore is more moderate than they would have in the past. Does that change the demand equation for you at all? Or do you think that you're just going to see enormous demand coming from that country?
I think you're going to see enormous demand that's going to stay or keep growing. I mean, look at per capita energy consumption in China. Compare it to the U.S. And no, they're going to keep needing more oil. And yes, there's probably going to be a bunch of bankruptcies in the property sector. There already have been. You'll see a bunch of regional Chinese banks that disappear. And that's just the nature. I mean, we've gone through that in the U.S. I mean, look at energy consumption per capita over 100 years in the U.S. We've gone through, world wars and Great Depression and economic crises. Energy demand just keeps growing. It's unstoppable.
So if we're at a higher range for oil, do you think that encourages other forms of energy, nuclear, all the things we heard about being talked about especially right when Europe was facing the crisis with the cutoff of Russia? Or is that not just long-term and not quick enough and not with enough political momentum behind it to make a difference?
Well, I think nuclear is the obvious solution. If, you came to me and said, we have this new technology that, produces clean energy at super low cost, that's amazingly reliable and stable, I'd say, let's go do it and do it at massive scale. Unfortunately, nuclear has, 70 years of baggage, and, there's been a couple of accidents along the way. And I think, humans get smarter and better. They learn from accidents, I hope. But no, I think nuclear is a large part of the solution. We own a lot of uranium through an entity called Sprott Physical Uranium Trust, because I think the demand for nuclear power is going to grow, and this is a deficit on the production side. But the problem is that a nuclear power plant takes 5 or 10 years to build, and that's not a short enough solution. I mean, step one is to stop retiring a bunch of these power plants that Europe, for whatever reason, still wants to retire. But I think that on the margin, that's very bullish for uranium demand. If you can save some of these power plants and maybe even turn some of the ones on that are mothballed. But that's really around the margins in terms of total global energy production. But sure, it would help. Absolutely.
Mm. So how are you trading this energy crisis, or what are the trading implications of the energy crisis that you see? Is it the straight commodities? How are you looking at this?
Well, the way I'm looking at this is that to solve the energy crisis, you're going to need incrementally a couple $100 billion a year of incremental demand above the current baseline of energy exploration, spending, drilling. And so we own a couple companies in that supply chain of companies that are helping to explore for oil. My particular focus right now is offshore. I own two companies. One's Valaris, the largest owner of offshore drilling rigs, Tidewater, which is one of the largest owners of offshore supply vehicle vessels. I mean, I think a lot of the incremental supply of oil is going to come from offshore, just because, like I said, onshore U.S. is kind of can't really grow much more. And a lot of the big discoveries are in countries where they're very open to oil exploration, and you're going to go where the discoveries are. So Guyana, Suriname, Namibia, all of West Africa. I think that's, Brazil. I think that's where a lot of the growth is going to come from. And so I want to be investing where the growth is going to be. So we own a lot of this equipment. We own downhole supplies. We own throughout the supply chain. We also own a company. It's a small little company in Canada that's rolling up older oil assets that are low decline, called Journey Energy. And then finally, we just own a bunch of physical. We own the Brent Oil ETF, ticker's BNO, just because there's some roll yield. We own a lot of call options on oil going out to 2025.
And what's the downside? We sort of talked before. You don't hear a lot of people talking about an energy crisis. You hear them talking about a banking crisis. You hear them talking about a hard landing. You hear them talking about, a knock-on demand destruction off the back of that. So it sounds like if the markets doesn't have their head wrapped around this, where's the pain trade? What suffers as a result of this?
Well, I think consumers going to suffer. We can have a banking crisis and an energy crisis simultaneously. There's nothing that says you can't. In the 1970s, we did both. I kind of think we're going to do both. I think the pain trade is anything tied to interest rates. I think that, at some point in the not so distant future, Powell is going to have to make a choice between saving the banks and, chasing oil across the screen. And I think he's going to decide to save the banks just because that's probably the more politically expedient thing to do. And he's going to let inflation run really hot. And I think the net result of that is the 10-year probably falls apart, and then all the banks fail. Because, if the 10-year goes to some high single-digit number, I don't think you have any banking sector. It's not just the little, kind of fragile ones. I think you're going to have like a banking crisis with an energy crisis. I think it's going to look a lot like the 70s.
Cubby, that's a horrifying outlook that we're facing.
Not if you own energy.
Not if you're prepared. But a banking crisis and an energy crisis, that would be a massive hit to the global economy, no?
Not sure. I think you're going to see a wealth transfer, not a hit to the global economy. I think people forget these things go in cycles. In the late 1970s, New York City was bankrupt, and Houston and Dallas was where all the wealth in America was. And then it took 40 years, and the pendulum swung the other direction. And then I think the pendulum's probably going to swing back the other direction. And maybe it doesn't just go to Houston and Dallas this time, but Kuwait was booming last cycle. Why can't Dubai boom this cycle? That's effectively the banking hub of the Middle East. I just think you're going to see wealth move around the globe and transition. It's going to be pretty terrible if you own Manhattan real estate, but I don't own Manhattan real estate. That's not my problem.
I know. And every time we talk, you have a very global view of these things, which I think is helpful because a lot of analysts come from a very financial center, London, Hong Kong, New York. So that I think that does tend to color it. What about emerging markets? How do they fare in this? Because when I hear banking crisis, I understand what you're saying about wealth transfer. But when I hear banking crisis, energy crisis simultaneously, traditionally emerging markets haven't done well. But again, is this maybe a new period where that's not the case?
I think emerging markets, everyone just puts it in a bucket and then puts it into an ETF. And that's the wrong way to look at it. Every country has its own dynamics, its own political situation, its own benefits and costs and benefits. Like, I think you have to look at it on a country by country basis. It's a very Wall Street finance world view. Emerging markets, let's go buy that ETF. Frontier market, let's go buy that ETF. Well, I mean, you're talking about 200 countries. Like, you have to pick through them. And I'm not an expert on all these countries. I don't think anyone could ever be an expert on all of them. But no, I think some will do very well and some will do very poorly. Just going back to the 1970s scenario, I think it's really important to remember that, we all look back on the 1970s and, we think of like bell bottoms and, gas lines, but that wasn't the whole 1970s. There were periods where the economy did very well. There were periods where the economy did very badly. Interest rates, moved up and down, inflation, oil prices, there was just a lot of volatility. I think, the 2000 to 2019 before COVID, I mean, yeah, we had the GFC kind of in the middle of it, but it was a very linear progression with like 2 bad years. And, I think what the 1970s showed with a lot of volatility is probably more likely to be what the next decade looks like, which is, good for a hedge fund like ours that, craves volatility. I think it's gonna be difficult for people that are used to a very linear world.
Yeah. What about individual investors in that kind of scenario who don't maybe have the tools you have to invest in these types of places? Is it going to be, are we just going to see, either a painful sideways grind or equities, which is most people are in, just have a really tough time? And bonds, maybe.
Well, I mean, I think bonds are just going to be vaporized. I mean, if you own bonds, you're going to lose most of your toys. But no, I think in equities, it's going to come down to stock selection. It's going to come down to owning things that are going to not just be, immune to inflation, but, pro-cyclically positive to what's happening with inflation. But for individual investors, I think you buy good companies with strong tailwinds and you go to the beach,
Yeah.
and more so than ever before, you just ignore the volatility and you use that volatility to your advantage to buy more when you have these, occasional crazy moments where things drop.
We get this comment often, and I've been talking to a lot of people. We've been going back and forth about the future, and you have this point of view, and that there are some people who have this idea that we are still in this we are going to once again be in a disinflationary period. The central banks have to bring rates down, right back down. They probably have to do QE because they can't have interest rates be high just based on the amount of debt. Like, what do you say to people who have a different view than you when you talk about this return to the 70s, volatile inflation, high commodity period? Where do you differ? Like, why is there such two distinct worldviews?
Well, I think people got lulled into this idea that deflation is systemic and that we can't defeat inflation. What we just learned in the last 3 years is that if the governments give everyone stimmies, there is no deflation. You have an inflation problem. If the government, gives 0% interest rates to banks, well, the banks just kind of sit on the money and nothing happens. So we can solve deflation at any moment. You just give everyone stimmies. And stimmies are popular, and politicians do popular things. And if times get tough, there'll be more stimmies. And as a result, I just don't think you're going to have deflation. I just don't see it. And I don't know. I think there's been this change of mindset amongst voters and citizens where people look at this and they say, we kind of like stimmies better. No one wants hard times. Like, stimmies are fun. And I just think you have this total change of mindset. And so, no, I just don't think it's possible that you could have deflation. And if you do have deflation for any short period of time, it's met with stimmies. I mean, go back to the 1970s. I mean, there were periods where the economy was really terrible. And then, on the fiscal side, they spent a ton of money. And then, the economy kind of boomed and inflation took over. It's kind of this yo-yo. And I mean, you look back to any inflationary period. I mean, I like to talk about Weimar just because it's like the most well-documented inflation, even though it's 100 years ago. There were periods where, the stock market dropped 50, 70%. And you had the currency actually, appreciate against gold. And speculators who were over levered got margin called. I mean, you look at a chart of Weimar today, and it's just a straight line. You have to use a log scale to look at it. But if you were living and breathing it, there were terrifying shakeouts along the way where the government tried to arrest the inflation, and they never quite got to deflation. But I think the cycle will look like that. Hopefully, not with the same amplitude of Weimar. But I think there will be moments of time where, the deflationists will have their day. They'll have their 3 to 6 months. And then it'll all start up again because the structural reasons for the inflation haven't been fixed. And the economy is still growing.
I think that is a really important point when you're trying to figure this out, is that it's the structural reasons that you have to keep an eye on, because that's going to be where the trend is, even though you're going to have moments, as you say, where you're going to see swings in everything. But if those structural reasons are there. Last question I wanted to ask you is the ESG push. Is that dead if we're in an energy crisis where we're looking at a much higher range for oil and a long runway to get some of these other or can these things coexist at the same time as people search for alternatives?
Well, I mean, I think we're nearing peak ESG, which is probably a good thing, honestly. But no, I think you're going to have your adherence to ESG, and it's like, religions kind of come, they peak, they die out. I mean, no one practices Roman religions anymore. I mean, I can name like 3 of the gods, and I'm a Roman history major. These things, they peak, they crest, and this little religion of ESG, it's been around for a while. It peaked, and there'll be some diehard adherents, but I think the vast majority of investors want to make money, and it's great if they're doing something that has a social good, but most of them just want to save for their retirement. And when the two had an overlap and a bunch of these green stocks were going up because we had a speculative bubble, everyone said, this is great, I'm checking both boxes. But now they've lost a ton of money on these green stocks. I think they just want to save for their retirement. No, I think you're going to see a shift, and it's probably good because ESG is just a tax on humanity. And I'm successful. I can afford that tax if I have to. But you look around the emerging worlds, and it's a real detriment to 6 billion people that want a better standard of living if they can't afford the things to pull them up out of poverty effectively.
We have a couple of quick questions. We have questions. We only have a couple minutes to get through them, but I do want to ask. We have a question. Are you trading nat gas in any way or pipelines?
No positions in nat gas or pipelines. I wrote some puts on nat gas a couple months ago and made a little money, caught a bounce. But no, I don't know enough about nat gas. I mean, I look at weather models and they make no sense to me. It's a byproduct to energy, to liquids production. I feel more strongly about liquids. And of course, I'd rather nat gas prices be high because it's good for liquids producers, but I just don't have a view.
And are you short-term or long-term on your views?
I'm pretty long-term. I mean, I think people have this crazy idea. They show up in the morning and say, what did OPEC just do? Like, of course, we're talking about OPEC because it's fascinating. But, OPEC has, raised and cut. They do all sorts of things. This is all short-term. I mean, longer term, we're going to have an energy crisis, and they can forestall it a bit. But the only way you're going to avert an energy crisis is to incrementally spend a few $1 trillion, a few $100 billion a year, every year for 5 years. And no, we're going to have an energy crisis. And so it gives me the peace of mind and the fortitude to stay through a shakeout where, look, oil dropped from 130 to 65. Fortunately, I don't own much front month oil, so I kind of ignored it. My services companies went up the whole time. I bought the right part of the oil market. But it gives me the fortitude to kind of just ride through this volatility where a lot of people are questioning your thesis, and you could just say, I don't care. I mean, that's just front month oil.
Yeah, which is a really good point to make. And for anyone who missed it before, when you just said I didn't have any of those contracts, but you are in Brent as the commodity as well as the exploration, right? And producers?
Sure. We own the Brent oil ETF because I want to earn that roll yield. We own quite a lot of WTI 2023 and 2025 call options. I mean, notionally, that's one of the biggest positions in my book. I actually think it is my biggest position. But they're call options. Some of them are out of the money. Some of them are in the money today. And then we own service companies, Valaris and Tidewater, and we own one producer, Journey Energy. We own some other, bits and pieces, but those are the main, components.
A question about, are you looking at EVs at all? I mean, you're focused on an energy crisis. Someone's asking about the realistic pace of EV penetration relative to net zero prices. Are you looking at that as a byproduct of if people are facing potentially big spikes in oil, or no?
No, I think EV is going to be something you're going to go to a museum with my kids and be like, wow, that was an evolutionary dead end and we all wasted trillions of dollars on this. No, I think there's no future to EV.
Really? Why?
Because it destroys energy. I mean, you have this concept called EROI, which is the return on energy you put in. I mean, in EV, you put more energy in than you get out. And so as a result, it's just like a thermodynamic rule. It won't work unless you subsidize it. I mean, what's the reason for EVs? It's because supposedly it produces less carbon. But through the full life cycle of owning an EV, because so much carbon has to go into the stupid thing, it doesn't use less carbon. It's actually, you're better off having a gas guzzler. If carbon's the thing you're caring about, you're caring about the total cost of using the car, or the energy in versus energy out. Almost any component you look at, you're better off just having an internal combustion engine. And those engines have actually gotten very efficient over the last couple of years. And no, I think that's the future. I mean, if you kind of want to be a snob and say you got an EV, then be a snob. I mean, it's a nice thing to have if you want to show off that you have a thing. For me, I have a truck. It doesn't bother me at all, and I'm proud of my truck. but I mean, this is just like a consumer choice issue. In the end, how do you want to get from point A to B? What sort of engine do you want? I think it's a consumer choice thing. But in the end, most consumers will be price sensitive unless there's massive subsidies, which there are. And even with the massive subsidies, most consumers still want the ICE vehicle. And so, I tend to think you're going to see more ICE vehicles. And as more of these EVs age and people realize what happens to battery degradation with lithium-ion batteries, and the fact that the lithium-ion battery is such a large component of the total cost of a car, and when you at year 5 or 6 have to replace 30-40% of your car's initial cost, people are going to realize that the lifetime cost of owning an EV is astronomically high. And as a result, I think adoption will decline. I mean, the main, in the U.S. at least, and in other countries, I mean, the big push on EVs only happened 2 or 3 years ago. So we're kind of 2 to 3 years away from learning that it's a terrible vehicle.
That's gonna hurt the ears of many a Tesla shareholder, I'm sure.
Yeah, they've done so well in the markets. Let them be.
You mentioned something before about the rates going higher on the U.S. Because we're in this inflationary. So you see U.S. rates, regardless of what the Fed does. You see Treasury rates going higher.
Well, I don't think it's the Fed's decision, really. In the end, the Fed's going to have a choice. And look, short term, they can control rates. They can do their Operation Twist, and they can, play around with the yield curve, and they probably will. But, they're going to have this choice. They have to save the banking system or chase oil across the screen. And I think they're going to save the banking system, which means they're going to probably halt. They're probably going to do another 25 or maybe another 50 from here, and then they're going to halt. And you're still going to have the banking system kind of on its knees. But the problem is that if you're halting and inflation is accelerating, and I think in the back half of the year, this year, it's going to accelerate. I mean, look, we're seeing the CPI. It's month over month is flattish, I guess, and everyone's declaring victory. But think of it: we're going up against 130 oil right now. We're going up against peak inflation things from the Russian invasion, and I mean, inflation is still 6 and 7, depending what metric you're looking at. And I think that when we in the back half of the year, when we start going up against $80 oil, you're going to see teens CPI. And as a result, if the Fed doesn't keep raising rates, I think the long bond's going to detonate. And the Fed's really, really trapped. And I'm not sure if they know they're trapped, but they're really, really trapped. And Even just keeping interest rates at 5%, you're going to see at the fiscal situation, you're going to see an increasing percentage of tax revenue just go to interest expense because, our government's run by fools, both parties. And they had a long period of time where they could have termed out their debt for 30 years. And instead, they kept the debt really short-term debt. And the net result is that when they have to refinance this debt over the next couple of years, it's going to be at much higher rates. And it's going to squeeze out pretty much everything else the government tries to do. And the government will respond by printing a ton of money because that's what they know how to do. And so it's going to be very inflationary. All these things are bad. And, I think it's going to be a very great moment in time to be a macro investor.
Yeah, because you're looking for opportunity. Last thing.
I have a roadmap. That's an important thing. I'm a history major. I'm not a finance guy. And I've studied inflationary crises over the last 200 years. They all kind of mirror each other. It's the Mark Twain line about them sort of rhyming. These things all sort of rhyme. And so if you have a roadmap and you study 20 of these, you kind of know how it's going to meander. And this one will probably mirror the last couple ones, and I don't think we're Zimbabwe. I hope not. But I think you're going to see a decent chunk of inflation here. And I hope it stays in the teens. It doesn't get any worse.
Fantastic stuff. Cubby, last thing, if for some reason there's resolution, it's hard to imagine right now sitting what we're looking at, but if there's some kind of resolution with Russia and Ukraine, any chance that Russia coming back online or their supplies getting out to more of the world help ease the pressure on the downside? I know we've got a question about that.
Well, Russia until, until May, when the Russian cutbacks take effect, all the oil that Russia wants to export is getting exported. It's going to India and China. A lot of it's getting refined and it's getting sent back to Europe. All that oil is making it into the market. So if we're suddenly friendly with Russia and we say, Russia, come give us oil, Russia is just going to say, okay. It's just going to save them a bunch of ton miles because right now you have a tanker taking it all the way around Europe and India and back again. It's not going to change anything. All that oil is already here. I think longer term, you might see more U.S. service companies go to Russia, in which case they can grow their production. But that's, a 5-year, process. In the short term, if, there's peace and everyone's friends tomorrow, nothing changes.
Cubby, it's been amazing to get your point of view. I'm so glad we're able to make this happen because it's a narrative that's certainly not being discussed a lot. So I totally appreciate you coming on with us.
Yeah, happy to. Anytime. Happy to chat.
Great stuff. Harris Kupperman, thanks so much. We'll be back at 4 p.m. for the daily briefing. Hope you join us then. In the meantime, take care and good luck out there, everyone.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.